mean, today the current market conditions are just very interesting, right? Because we've had this, I think, rather large swings in sort of macro forecasting over the last 12 months that it's fairly rare that we've seen this in the past. I look at, what we were worried about all last year leading up October, November. We were worried about this inflation and interest rate increasing spiral. And if you were panicking, you were seeing no end in sight. And then right around the whole Davos meetings, all of a sudden people started talking about, well, I think we're okay. We're sort of past that point. And so there was a pivot away from that sort of disaster scenario, if you will, about ever increasing interest rates and inflation, to now the more real. And I think Natixis house call is that we won't even see a recession right now. I personally believe in the business cycle. Before the pandemic, I felt that we were sort of headed for a recession, and then you had this obvious disruption in the pandemic with both, the loss of productivity, but also massive liquidity. And so I think people are still trying to figure that out. What does that mean? I personally believe that we are still headed for a recession, just maybe later than what we might have thought, or what I thought 2 or 3 months ago. I think the distressed debt, I looked at Moody's, their B3 count the other day in terms of, actual positions, and it's up to about 220, which is a long-term average. So, okay, that's not bad, but it's from a low of 175. So obviously the trend, even though it's an average right now, the trend is not good. I think one of the other things we worry about is that, my understanding, even in some of the surveys I've seen, is that the last 3 or 4, 5 years of expansion has led to cheap bank financing. And so I think right now, 75% of the leveraged loan market just has bank loans. Whereas, if I go back to like 2012, 2013, there was only 50% had just bank loans. They had other levels of debt. And I look at that from a restructuring perspective. If you do have difficulty, it's nice to have debt that is used to earning more, used to taking more risk, already involved in your company, so that when you obviously have a cushion to the senior lenders, but you also have people who are interested in taking more risk involved in your loans, and so that can help in restructuring. And the less of that goes on, the more difficulty you may have in terms of some of the other restructures that may come up. So specifically, I think the two industries we're maybe more concerned with these types of conditions is, one is the healthcare. We've seen a lot of PE firms investing in healthcare and then making them more efficient, but healthcare tends to not have that explosive growth. And so when you raise the interest rates on that, so we're concerned in general about healthcare. Obviously, there are some good healthcare situations and some bad ones, obviously, but just in terms of sort of a general industry. The other thing we're maybe more concerned about is the service industry. Again, not usually something that's been a problem in the past, but I think with some of the labor market stresses and things like that, those are causing costs to go up. And again, you're not seeing any growth to grow out of the fact that the interest rates are going up. So those are the concerns. I think in terms of growth or the good things. Like my fellow panelists, we are surprisingly not seeing a lot of specific problems just yet. I think some of that is due to the hedging. I'd like to throw in an advertisement for our underwriting skills, but that's not the point. I think across the banking, we're not seeing the sort of explosion of issues that are popping up. And again, maybe that's because of the hedging programs that we've had in place. Obviously, with all the covenant lights, it's hard to know exactly. The market for leverage loans, again, we don't trade too much in this, but it clearly has bounced back. From I think July was sort of the low point there. So there's clearly more money and more liquidity around this market, which I think is positive for all of us. Private credit market has gotten bigger and bigger and bigger. And again, I think the pension funds are now putting 5 or 6% allocation into private credit. And again, more money into the area is usually helpful. Not for competition reasons, but in terms of risk reward reasons. And I think just a couple of quickies where I see the expansion areas. The renewable space, because the IRA Act, the Inflation Reduction Act, is clearly exploded. I think anyone sort of in that space has seen just tremendous explosion, and not just in new projects, but in, we'll call it warehousing for lack of a better term, but where private equity money comes in and actually buys some of those facilities that are already up and running, and leverages those on top of that. So there's all sorts of growth in that space, and that I see continuing, for a long time. So I think that's one area of people are going to be putting money into that. And the aerospace, chemicals, metals, and mining are the other things that we see growing, all related to renewable space and EVs and things like that. And the aerospace industry just feels like it has a lot to make up for.